Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Tom Callahan, CEO of Nasdaq Private Market, and Michael Weisz, founder and CEO of Yieldstreet. We're here to discuss the state of the private market, where investors are deploying capital and investor demand to get involved with the product. It is great to have the both of you with us. Welcome to Trade Talk. Certainly, Tom, private market has been a big topic of conversation in 2024, as it feels as if it's starting to ramp up again in terms of what's going to happen in the private markets, exiting deals, and the IPO market. What were some of the discernible trends for 2024?
Sure. Well, first of all, Jill, thanks so much for having me. It really is an exciting time in the private market, and it's important to put some context around 2024 because in 2021 in the private market we had a bubble. I think we can confidently say, looking back on it, at least in private assets, there's a real stretch in private company valuations. And then in the inevitable crash in 22 that was then extended into 23. So what we're coming out of this year is almost a 2-year market suspension. And that was in terms of private company, primary fundraisers, in terms of tenders, in terms of secondary trading activity. The market crashed so hard and so fast, just trying to figure out what a private company was worth for the last 2 years was really hard because those valuations oftentimes were down 30, 40, 50% from their last primary round. What we saw almost immediately coming into 2024 was almost an explosion of liquidity. It's almost like 2 years of pent-up demand that we're seeing being released into the market. For us, we run a trading marketplace. We also run a tender business. And almost from the first day of January this year, our tender business got really active and has stayed active. That's where the company hires us to run a liquidity program for their employees. Really in the second half of the year, and I'd say really almost since the election, the block trading side of the business, that's where just a individual shareholder needs to sell stock. That part of the business has really started to pick up as well. So it's really exciting, and from what we can see, 2025 is going to be equally busy.
Yeah, a lot of that uncertainty has been removed from the market, Michael, but I want to talk about valuations for a moment here. Do you think that valuation reset almost needed to happen, and not even in terms of multiples, but in terms of not growth at all costs, and operating efficiency and governance and so forth started to matter more, right? You had to show a path to profitability. I had a VC guest on the show yesterday, and he said it's not about playing to win, it's playing not to lose, and thinking more operational at this point.
Jill, it's great to be back, and thank you for having me again. I think what we saw was very much reflective of what we've seen historically. We peak at different times in the market, we require a correction, there's a spread between buyers and sellers, market freezes a little bit, there's a debate as to what is my company worth, what is my holding worth, and over time, as different factors come in, it builds more confidence. In this case, there was the election, there's global uncertainty, there was the rate environment, there was a whole bunch of things that we have had to tend with in the last 18 months in the market that needed to play out. And one of those things was the zero interest rate environment. And when we were in that environment, it was very hard for investors to generate a return off of their cash. And so when that happens, growth becomes very cheap because the money is very cheap and people are willing to pay out for it substantially. As rates moved up and you were able to generate pretty attractive returns in private credit, in senior secured, in bonds, in other areas of the market, investors were no longer willing to pay the same valuations or allow companies to have growth at all costs. And so, yes, I think that we have seen a tightening of the supply of capital into ideas and to innovation. We have seen a tightening in operational excellence. We have seen a tightening in unit economics that investors want to see. But it's not something new to us. I think it's just what we're experiencing at this part of this cycle in this time.
Yeah, I mean, we could be having a conversation about some other anomaly 10 to 15 years from now, to your point.
We will.
Right.
We absolutely will.
Right.
And we did 10 to 15 years ago.
Right. Yeah. And coming out of the financial crisis at that point, and then there we were at 0% interest rates. So again, next decade we'll be talking about this. So Tom, why are companies staying private for longer?
For a lot of companies, it begs the question, why do they go public to begin with? Part of it certainly is liquidity. Liquidity for the founders, for the employees, for the early investors. There are certainly other reasons, having a currency to make acquisitions. It tends to be a pretty good PR event for companies. but liquidity undoubtedly is one of the main drivers. And for some of the private companies that we talk to, they're telling us they don't plan to go public anytime for the next decade. Some are saying ever. They just want to build their business for the long term and not have to manage to quarterly earnings. So they come to us to try to relieve that liquidity pressure. Think about it. If you're a private company CEO and you're competing against a public company, for your employees, they have a choice where they want to work, and they could go work for a public company that would give 3-year cliff vests RSUs that have automatic liquidity that can be liquidated on an exchange. Well, the average private company now waits 15 years before they IPO. Kind of hard to say to a 25-year-old software engineer, wait till you're 40 to buy your first house. So it's almost an imperative, almost an HR benefit that is a requirement to attract and retain the greatest talent. So what they do is they'll run tenders on platforms like ours where they offer partial liquidity to employees, 10, 15, 20%, so they can sort of recognize the value that they're helping to create while at the same time retaining them.
Yeah, and speaking of demographics, Michael, it's interesting. We have this big wealth transfer that's taking place, right? And the demand for alternative investments and access to private markets is another interesting area within the space.
Yeah, so I think most recently Bain may have dubbed it as the most exciting opportunity in financial services. And so sort of zooming out from a macro perspective, in the US alone, we're looking at about $70 trillion of wealth transfer from the boomers to the next generation. Globally, that's about $100 trillion. So there's a massive amount of capital moving, and the question is, where are those people going to be allocating those dollars? Bank of America earlier this year in a report said that millennials, so think of folks maybe under 45, are 3 times more likely to invest in alternatives. What we're recognizing is that the individual investor, the self-directed investor, needs a few things. 1, they need good education. 2, they need the right user journey. They need to be able to learn and understand what is the optimal portfolio supposed to look like, how do I build that portfolio, what products are available to me. 3 is they want a beautiful and delightful digital experience. And there are very few places that they can access that. And so when you look at a lot of the different market forces, on the supply side, we have, Bain recently said by 2032 we'll have $60 trillion in alternative investments. That's how big the alternative world is getting. To your point, there's actually roughly half the number of public companies that there were about 15 years ago. And so what companies have realized is that getting financing shouldn't be a cookie cutter experience. We have our own needs as a company to solve the challenges, the opportunities that we're working through, and so the financing should be tailored to us. The private markets give you that flexibility in terms of private credit, in terms of private equity. And that's what's driving and fueling the growth of the private markets versus the public markets. And so the institutional investors and the billionaires have access to these products for quite a while, and more recently, greater access. And there's been education for them that went from a very sort of nascent, market that was hard to understand to a market where institutions can understand a lot more. Today, we're seeing that adoption curve at the retail high net worth level. So a lot of focus is on the types of products that are right for that market, the way to educate them, the way to provide access to them, and the way to experience those products. So we could talk more about it, but there's been an incredible amount of growth and energy and focus in the alternative markets and the private market space.
It's a great point. At the same time, the number of publicly traded companies dropped in the last 15 years from about 8,000 to closer to 3,000 today. Think about it, 15 years ago, we talk about unicorns, private companies worth $1 billion. You can count the number of unicorns on one hand. It was Facebook, it was Zynga, it was Groupon. It was kind of a big deal. Well, in the US alone, there's something like 1,200 unicorns today. I think one of the things that surprises people when we talk about the private markets is the size. Just measuring unicorns is about a $3.5 trillion asset class. That's bigger than the US municipal bond market. So if anyone thinks that the private markets are some sort of niche little market, they need to look again.
Yeah, and Yieldstreet, you guys have been on the show for a number of years now, and the question that I ask every single time is, in terms of how you are educating your customers, because the private market is a different type of asset class than stocks or bonds that tend to be more liquid. So tell us, how you're educating your customers to make sure that they understand this.
Sure. So listen, we've been here a number of times before, and we love to discuss that point. Today, at least for the people who don't know Yieldstreet, today Yieldstreet is the preeminent online platform enabling self-directed accredited investors and affluent investors in the U.S. to invest all across the private market. So when I say that, think about real assets like real estate, think about private credit, private equity, venture, growth, so really giving you the opportunity to build a diversified portfolio across the private markets. Jill, to your point, it's got to start and end with the customer experience. We learned over the years we need to meet the customers where they are. The way we do that is number one, through education. We have to help people understand what is the private markets, what is the difference between a private equity opportunity, a private credit, or a real estate opportunity. So that's the first thing we do. We lean into education, different forms. There's written, there's webinars, there's videos. We recognize that people consume information today in a different way than maybe just a 200-page private placement or a book. So it's about making that experience user-friendly and easy. The second thing we do is we focus on the user journey. So we know that it takes people time and trust to learn which products to build their portfolio around. And we have to meet the customers where they are. So what that means is there's going to be three types of customers broadly. Do it myself, guide me, do it for me. The do it myself customer wants as much education as possible and wants to pick his or her investments and build their own portfolio. The guide me portfolio wants to be able to tell us who they are digitally or with one of the advisors, who they are, and get a recommendation of the portfolio and the diversification that they should invest in that's right for them potentially. They ultimately still want to make the decision. So they need the education, they want the recommendation, but they want to make the decision. The final piece is the do it for me. It's the customer who maybe has a $200,000 account on a Schwab or Fidelity, knows that it's important to now recast their portfolio, have 30% in alts, comes to us to get it, says, can you do it for me? Answers a bunch of questions, suitability, and understanding the risk and return criteria that customer is looking for, and we place them in the right product. So there is no silver bullet. It's purpose-built for the affluent retail customer, big focus on education, big focus on user journey, big focus on simplicity and digital experience.
Yeah. In terms of private market investors, Tom, engaging with your platform, where are they focused? What types of companies, what types of stages, what types of sectors? Is AI still the hot story?
It is still the hot story for sure, and it was the hot story of 2024. The classic investment in private markets is that if you have visibility into when a company's going to IPO, you can typically buy in the private market at a discount, sometimes as much as 30 or 40%. And then if you think that company is going to be IPOing in the next 12 to 18 months, and you think it's going to do well post-IPO, you buy at a 30% discount, it pops, you sell it after IPO, and you can take out 60%. That's sort of the classic private market trade that people do. Investors get more confident as they get more confidence around exits. So that's been one of the big challenges in the private markets over the last 3 years, that the IPO market has really been in a challenge state, let's just say. Now, everything we're seeing and everyone we're talking to is indicating that in 2025, the IPO market is very, very likely to reopen. That's going to give private markets a lot more clarity into what is the duration of the investment they're making. When you're buying a private company, obviously they don't pay dividends. What you're playing for is the capital appreciation. And you want to know, am I making a 1-year investment, a 2-year investment, or a 20-year investment? The answer to that question is really going to inform the valuation that you put on the company. So as confidence around liquidity grows, investor confidence grows in the private markets.
Do you think that will play out in 2025 as well?
From everything we're seeing from all the equity capital markets partners that we talk to and the people that are in the IPO business like Nasdaq, everything they're telling us is that very likely to see an increase. But again, back to the point before, there's a lot of companies that are never going to they're going to IPO no matter how robust the IPO calendar becomes. It's just not in their business plan. It's not how they want to manage their companies. And so platforms like ours that can really generate predictable, stable liquidity for them allows them to stay private, to recirculate their cap table as the strategic needs of their business changes, to offer liquidity to their employees, and to really function as a private company for the long term.
Right. I mean, another catalyst too is there's a lot of VC dry powder.
There's a lot of VC dry powder. There's also, on the other side, a lot of VC trapped capital.
Right.
Because remember, the average VC vehicle is 10 years. I mentioned before, the average private company waits 15 years to IPO, so you've already got an asset liability mismatch. And I'd say one of the most frequent calls we've been getting in the last 12 months have been from VCs with funds that are end of life, so they're at 10 years. They have good companies that are doing well, that are growing, succeeding, and valuable. They're just not looking to IPO anytime in the next 2 to 3 years. So what do they do with that position? It creates a lot of problems for the VC. They can try to sell the position. They can do things called continuation funds, which are very expensive and difficult. They really have a lot of bad options. So having a robust secondary market where they can sell those positions when they need to almost becomes an imperative to sustain the VC business model.
Yeah. And of course, when you see more private market demand, that means more product on your end.
So I think what we're seeing is I look at it akin to 10, 15 years ago as financial services was becoming more online. Right? It's a similar adoption curve. And so when we started the business 9 years ago, investors really didn't understand, at least the retail affluent investors didn't really understand what the private markets were and what's the right portfolio. KKR recently issued a report that talks about 3 types of portfolios between moderate and call it risk plus that are all a function of 70% stocks and bonds and 30% of variation of private markets. If you want better total return, you're leaning more heavily into private equity and venture and growth. And if you wanted more stable, you were leaning into private credit. What we're seeing, and listen, we're the largest self-directed online consumer platform. So we have a lot of sort of insight into where consumer sentiment is. I always like to say we're a demand-driven platform. We see what our customers want, and then we talk to our partners and we bring that product forward, right? And so what we're seeing is increased demand every single day for private markets, right? So for example, if you look at the third quarter for Yieldstreet, month over month we had increasing sales. In October, we had 25% higher sales than the prior 3 months. In November, we beat October. In December, just over the weekend, we're already tracking way ahead of where we were for November. So consumer sentiment is there. It's bullish. They're looking to invest. What folks are doing is listening to all of the market education. This is not a Yieldstreet or Nasdaq private markets thing. This is Apollo, KKR, Blackstone, BlackRock, Goldman. Everywhere you go across the street, there's talk of the importance of having private markets in your portfolio. So investors are looking to diversify their portfolios. There are limited places to access the product. And what you're hearing from both Tom and I is increased demand for the products that we're offering, which are all in the private markets.
Yeah. You also want to be mindful of not creating a bubble out of that either, in terms of suitability.
Yes,
right.
Suitability, and we're a long way from a bubble, and broadly in the private markets, because in many sectors valuations are still down 50, 60, 70% from the 2021 highs. I had an investor recently tell me that he thinks investing in private equity right now is the equivalent of buying real estate after the 2009 crash, because there's so much distressed sellers and valuations have collapsed so much. But your point about suitability is really important. One of the really key distinctions between the public markets, which most retail investors are familiar with, and the private markets is information asymmetry. You can pull up your iPhone right now and within 10 seconds look at any publicly traded company and find out all the information that you need to make an educated decision to invest or not. In the private markets, unless you are an investor that's on the cap table, that's maybe on the board, there is no information available. So the owners have a full information and potential investors have none. And so that creates a lot of challenges. One of the ways we're trying to solve that is that you can go to public sources. They're hard to get. Things like certificate of incorporations filed with the state of Delaware, which is where a lot of private companies are registered. We go and physically pull those and digitize them, and we try our best to present all the information relevant that we can from public sources for investors to try to close that information asymmetry gap.
Yeah, I think it's important.
I feel like for us at Yieldstreet, it's a little bit of a different component. So we don't really offer single company exposure. What we are really offering is often the same types of products that are available to family offices and institutional investors. But we've been able to leverage technology and structure and the new product creation like interval funds and 40 Act funds and other components to make these products available and more accessible to the audience. From a suitability perspective, I would say there's 2 things. So one is there is a lot of sort of of regulation and a regulatory box that you definitely need to comply with. And there's education around that, and there's accredited investor requirements, and a lot more. And we do all of that. The other part that's even more exciting is how AI is playing into our world, and we touched on it a little bit before. But for us at Yieldstreet, we've leveraged AI in a couple of different ways. And one of the ways that's most exciting is, together with the standard suitability, is also leveraging different AI tools and data points to understand what is actually right for the person that we're talking to at that particular time, and how to help them think about both risk-return profile as well as understanding the different investments. And so really, the job of any investor, individual or institutional, is the same. It's to define what is my risk criteria and to get the best possible return for the relative risk I'm willing to take. That's the job. It's very simple. Now, in the public markets, you do that by toggling up or down the level of debt or equity you want. If you take equity exposure, you are taking a greater number of outcomes, i.e. volatility, but a higher potential return. In debt, you're taking fewer outcomes, less volatility, less upside potential. The same exists today in the private markets, and we're trying to use all the tools we can to bring that to the benefit of the end customer, of the investor who's looking to diversify his or her portfolio.
All right, appreciate both of your insights. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.